Hi everyone, my name is Aina Nursyafieka binti Muhammad Sharif. My metric ID is 2023497666 and I'm from class NBF4N. And today I will be presenting on the corporate financial decision making, which focusing on the concept of capital structure. This presentation is based on my assignment for FIN537 Corporate Finance, and it explore how firms strategically manage debts and equity to optimize value, especially in Malaysia's current economic climate. Let's move on to the first slide, which why capital structure matters. Capital structure refers to the mix of debts and equity a company uses to finance its operations. In simple terms, how much does the firm borrow and how much debts it raised from the shareholders. This balance is crucial. Too much debt can lead to the financial distress, while too much equity can dilute ownership and reduce profitability. For example, as you can see in the table here are the description of the source of capital. For example, we have equity. Equity can define as owner investment, which common stock retained earning. For example, 5 million. Second one is debt borrowed fund, which consists of loan, bonds, and notes. Example, this company have 3 millions. So the total capital combined funds used to finance the firms is 8 millions. Why capital structure matters? Because the first one is a firm with too much debt may face financial distress or bankruptcy in earning fall. The second one is a firm with too much equity might miss out tax benefit and could dilute ownership. So, the goal for the two objectives is to find the optimal mix where the benefits of borrowing, for example, interest, tax, shield, outweigh the cost of financial risky. Now, let's move to the next slide, which optimal capital structure. But what is the optimal capital structure? It's the point where the cost of capital is minimized and firm value is maximized. Using the statistics trade-off theory, we can see how firms weigh tax benefit from debts against the risk of distress. Tools like EBIT, EPS analysis help managers evaluate the scenarios. For example here, in high EBIT condition, leverage boosts shareholder returns, but in recession, it could lower earning per share. So, what we can do here is to find this balance. Financial manager utilize analytic tools such as EBIT, EPS analysis to evaluate how different financing option affects earning per share at various level operating income. So, to break even EBIT analysis, identify the EBIT level at which debt financings become more beneficial than equity. Next slide is the factor that influence the structure decision. Several internal and external factors influence how firm choosing between debt equity financing. These factors help to determine the risk level, cost of capital, and flexibility of firms. Understanding them is essential for making informed capital structure decision. The first factor is business risk. Business risk refers to the uncertainty in a firm's operating income due to the fluctuation in revenue and cost. Firms with stable and predictable earnings are better positioned to take a debt because they can really make interest payment. So, conversely, firms with the high business risk, such as startup or company in violated industry, tends to rely more on the equity to avoid the fixed burden of debt repayment. For example, we have here is a utility company with a stable cash flow may have higher debt capacity compared to the tech startup. The second point is tax position. Interest payment on debts are tax deductible, which create a tax shield that reduce the company taxable income and overall tax liability. So in contrast, Firms with low taxable income or those that benefit from other tax incentives might not gain much from additional debts. This implication, tax consideration often make that financing more attractive, up to the point where the benefit of the tax shield overweighed by the cost of financial distress. Let's move on to the third point, which financial flexibility. Financial flexibility is the firm's ability to raise capital when needed without excessive cost of delay. Companies that anticipate future investment opportunity may avoid high level of debt to maintain room to borrow later. A low debt firm can act quickly when opportunities arise, giving a strategic advantage. The fourth point is growth opportunity. High growth firms typically have significant. The fourth point is growth opportunity. High growth firms typically have significant investment needs but uncertain future earnings. They prefer equity financing because it does not require fixed interest payment, it avoids the risk of default, and it aligns with long-term investment horizon. This consideration issuing debt for uncertain future cash flow could lead to liquidity problems. Now, the next point is market condition. Firms are influenced by prevailing economics and capital market condition. In favorable market with low interest rate, debt is cheaper and more accessible. During the market downturns or financial crisis, equity might be preferred or even the only viable option if the credit market tightens. For example, during the COVID-19 pandemic, many firms avoided taking on new debt due to uncertain cash flow. So, now we move to the management style and ownership control. Some of management teams are risk averse and prefer low debt levels to reduce the likelihood of financial distress. Additionally, issuing new equity can dilute ownership, which existing shareholder or family-owned business may seek to avoid. This consideration often influence the decision to use debt over equity or vice versa. For example, a family-owned business might prefer bank loan to retain full control over company decision. Now, the next slide is understanding financial distress. Financial distress occur when a firm struggles to meet its debt obligation. This can result in legal and administrative costs, lost productivity, and reputational damage. While offer tax advantages, excessive leverage increases the risk of distress. That's why balance is the key. So, as you can see here, this description is the direct cost. This description is the type direct cost, which is legal administrative fees, indirect cost, lost sale, productivity decline. So, for the overall impact, increased cost of capital reduced firm may value financial distress. So, financial distress and description of each type of financial distress, understanding financial distress and its consequences is critical in capital structure planning. While that provides tax benefits, excessive reliance on it increases the risk of financial distress. Firms must carefully evaluate the trade-off between the benefits of leverage and the potential cost of distress to maintain long-term financial health and stakeholder trust. So let's move on to the next slide, which tax effect cost of distress. Let's go deeper into this trade-off. Debts provide tax savings through interest deduction. This is the interest tax shield, but too much debt increases the chance of distress. So, the optimal point lies where the tax shield's benefit is maximized without tipping into harmful risk. So, in this slide, we'll be discuss about agency cost of equity. Agency costs refer to the common between managers and shareholders. Managers may avoid risky projects or misuse resources. To minimize this cost, firms adopt performance-based incentive and corporate governance system. These come with their own costs, which need to be factored into capital structure decision. So in summary, agency cost of equity highlight the potential conflicts between managers and shareholders when the ownership and control are separated. So these costs arise when managers act in their own interest rather than prioritizing shareholder value, while mechanisms like incentive and monitoring can reduce this conflict. And they also can incur additional costs. Therefore, understanding and managing agency costs is crucial for firms to maintain investor confidence, improve governance, and make efficient capital structure decisions. The next slide is pecking order theory. The pecking order theory suggests that the firm prefer internal financing first, debt second, and equity last. Why? Because issuing equity can send negative signal to the market, making investors think the stock is overvalued. Hence, most companies follow this natural order to maximize the market backlash and control loss. Now, let's move on to the signaling hypothesis. This leads us to the signaling hypothesis. Financing choices send a message. Why? If a firm issues debt, it signals confidence in future cash flow. Equity issuance, on the other hand, might signal that management thinks the share price is too high. That's why firms are strategic in how they raise funds, not just for cash, but also manage investor perception. So, in conclusion, capital structure is not just about numbers, it's about strategy. A well-chosen mix of debt and equity can reduce costs, manage risks, and enhance firm value. Through theories like trade-off theories, pecking order, and signaling hypothesis, we gain deeper insight into corporate behavior under uncertainty, especially in the post-pandemic Malaysia's